heading into next week's CPI acceleration. A, long oil. It now has a medium-term trade correlation of 0.79 to the U.S. dollar, and head risk signals continues to print higher lows and higher highs. That's what a bull wants to see. The top end of the risk range now up to 89.57 on WTI. And third, forget Apple for a second. How about that bull market in U.S. stocks? The broad basket of those, IWM, was down another 1% yesterday, taking a stride down to 7.5%, where the chart guys are chasing the right breakout in July. And going cash mode, cash room down 24% from its full investing cycle peak. And with that, Josh, I'll turn it over to you.
All right, great. Thanks, Ron. Thanks, everybody. So, yeah, I think just to sort of illustrate a couple of the top 3 points on slide 14, this is a chart looking back just at the last 6 weeks or so of the U.S. dollar here. Obviously, it's been pretty one-way trade. On the next slide, Russell 2000, I think this is sort of an important, if you will, kind of a fractal reminder that from the beginning here in late 21, IWM, small gap for Russell 2000, proxy here. It's obviously come down a lot. It's bounced since really the spring of this year, but over the last, again, 5-6 weeks, it's pulled back quite significantly again. So depending on sort of how you're zooming in or how you're zooming out, can certainly frame your reference, but it's important to keep context on the broader picture as well. So, yeah, I thought in the wake of yesterday's macro themes, mid-quarter update, I'd spend a little bit of time this morning talking about 2 things. One is the labor market, and the other is this resumption of student loan payments. So I'll jump in, and I think the idea here is to just try to illustrate a bigger picture, a few of the things that are going on. So on slide 16, first with respect to jobless claims, the initial jobless claims series has a pretty good history as an indicator. The value in it is that it's high frequency. The sort of weakness in it is that it's high frequency. So, you can look at the series. Certainly, you can follow it closely on a week-to-week basis. There is a lot of volatility. If we look at the rolling trend here in jobless claims, chart on the right there, we've been trending basically in the 240,000 a week range. We did get a very soft print, meaning a low number in yesterday's report, but I think the trend there is generally elevated, certainly from where it had been over the course of late 2022, when it was running in the sort of 200 to 210,000 range. So seeing claims generally trending up. On slide 18, we've got challenger job cuts. So, there's been a lot of cuts in tech. Again, there's some volatility in this series, but if we look at levels year over year, the last several prints have been up significantly over year. If we look at hiring announcements on slide 19, this is on a rolling or trailing 12-month basis. Those have been coming down fairly significantly. They're still positive, obviously, and positive at a pretty high level, 835,000 on a TTM basis. But as compared with early 2021, when we were up in the sort of north of 3 million range, obviously they've come down quite a ways. Next slide, slide 20, the Conference Board survey here. And I think you can sort of get a sense that we're trying to approach the labor market from a number of different surveys, not just one source or 2 sources even, but trying to frame it up by looking through the lens of a number of different reference angles so that hopefully we get as clear a picture as we can. So here's Conference Board survey data with respect to the survey questions of are jobs plentiful, are jobs not so plentiful. We can see, I think, pretty clearly that the jobs plentiful has been declining and is continuing to do so at a fairly brisk pace. Jobs not plentiful, picking up. If we go to the next slide, this is now data from Bureau of Labor Statistics, BLS. The job openings numbers there on the left, the so-called JOLTS survey, job opening labor turnover survey. And we can see that that's coming down now as well. Again, there's certainly volatility in this series in any given month. You can see how it does this sort of sawtooth pattern, but the trend is clearly lower. So we've come in from roughly 12 million JOLTS down to now inside 9 million. That's still well above what the pre-pandemic level was, which was around 7 to 8 million, but it is coming down quite swiftly now. The available workers per job opening there on the right still has a ways to go to recouple to its pre-pandemic level, but obviously appears to be trending higher now. Slides 22 and 23 is sort of a sector or industry by industry breakdown of where job formation, lack thereof, has happened month to month. You can kind of go through this on your own. I won't spend too much time on it, but what I would sort of call out here, again, you want to be careful in too much in any one month, but it is a bit notable to me that in the August survey for ADP, the leisure and hospitality sector cooled off quite significantly. You can see those sort of, that's the second row from the bottom in the top table. You can see that the 6 or 7 months leading up to August had seen quite strong job growth in leisure and hospitality, still positive, but cooled down quite significantly in August. So we'll see if that's the start of a trend. On the next slide, we have some of that same data, but broken out across the NFP survey as opposed to the ADP survey. Slide 24, and we highlighted this in our macro themes call yesterday, but slide 24, and I actually touched on this morning on the call, is an interesting one. It shows really two things. One, that there have been significant negative revisions to the monthly non-farm payroll reports. There was actually a good article this morning in the Wall Street Journal, of all places, talking about the dynamics within revisionary framework. In other words, it's interesting if you sort of think about markets generally, and you think about how they perform, how they react, what sort of things they react to. What you find generally is that they tend not to care much about revisions. So why do we care about revisions? Well, for two reasons. One is that when you go back and you look over the longer periods, over the last few decades, one thing you do observe is that when you get these revision trends that are consistent in nature, meaning directionally consistent, in the case of what we're seeing now, which is negative revisions, when you go back historically and you look at prior periods when that was the case, what you find is that at times when we were going into significant economic downturns, the same dynamic was present. You end up with significant negative revisions over significant sort of durations in those periods when economic downturns occurred. So I think for that reason it's notable, and so while the market at the moment doesn't care maybe so much about these negative revisions as a harbinger for negative forward dynamics economically, it's been useful. Steve. Next slide, slide 25. Just sort of a restatement there on the left of the table. Total non-farm have been negatively revised by 306,000. The private portion actually worse than that, negative 358,000. Another thing just to notice is that on the right, you do have these declines in the response rate to these employment survey statistics. So the response rate over the last several years has fallen from around 60 down to 40%. We see the same data in JOLTS survey as well. Next slide, we've talked about this a fair amount, but the amount of overtime hours clearly has pulled back, and has pulled back to levels. So this is not a rate of change chart, this is just the amount of overtime hours chart. And you can see it's at levels that generally have been consistent with prior periods of economic downturn, those gray shaded areas are recessions. And then on the next slide, 27, if we look at temporary staffing, that is declining year over year. It continues to. Slide 28, just looking at average weekly hours, those have been generally trending lower. The year-over-year change has been negative. Slide 29 is a chart that is interesting from a longer-term context standpoint. So if you think about the mix of national income as split basically between labor's income and non-labor income, i.e. Corporate income, what you find is that in periods of leading up to recessions, you've tended to see the share of labor income rise, and that's in fact what we're seeing today. We're seeing it sort of move up off this high 66, 67% level, currently at just inside of 69%. And again, you can kind of see the trend there over a longer period. Next slide, just looking at aggregate hours worked, aggregate labor income. The trend is there. Both have been trending lower time here. With that, I want to transition. So, in a nutshell, the labor market continues to cool. It's a bit of a conundrum here for the Fed because, on the one hand, you've got inflation that's still too hot to handle, 3%. On the other hand, you've got the labor market cooling, but at levels from both an NFP and a sort of an unemployment rate standpoint that certainly wouldn't warrant any kind of reversal in policy, and may not even be enough to warrant a pause with either the upcoming September or subsequent November meeting. So we'll see. I think the Fed Fund futures are still pricing in roughly a coin flip of a Fed rate hike at either this meeting or the next. So transitioning here from the labor market to the resumption of student loan payments dynamic that'll begin here shortly, next 3 weeks to be exact. We had some slides in the deck that went through the sort of dynamics here, and I think what's interesting about this is sort of twofold or threefold. One is that most student loans in dollar terms are actually held by high earners. And you can see that in the slide, or the chart there from Brookings on the right of slide 31. So in some ways, this isn't really a surprise. Slide 32 illustrates the more advanced education people receive. So in this case, DDS, dentistry, MD, medicine, getting your pharmacy degree, getting your law degree, getting your business degree. These are the people, or just your masters, whether it's in engineering or a broader master's. The people with the higher educational attainment levels at the median carry significantly higher student loans than those, for instance, with bachelor's degrees. So, to compare and contrast, the median bachelor's carry holder has a median income of around $60,000 per year, and median student loan debt of around $25,000. If we compare that with a dentist, the median dentist income is up around $170,000 a year, and has a similar amount of student loans, closer to $200,000. So, what's sort of interesting, if we go to slide 33, and this is a sort of a broader point here, but what's interesting is because of the student loan payment moratorium, we've seen this very significant upward drift in credit scores. So these are Equifax risk scores. Similar dynamics can be seen across FICO scores. But what's happened is that you've essentially lifted the performance profile from a borrower standpoint really across the spectrum. So if you look at the sort of width of the bands transitioning from these different sort of tiers, so the sort of 620 to 719 cohort moving up into the 720 plus cohort, and maybe more importantly, the share moving from sub 620 up to 620 to 719. The width of the bands moving higher as compared with the width of the bands moving lower tells you that far more people have been moving up in their credit score tiers than have been moving down. So what that means is that you've sort of had an across the board upward trend in perceived credit quality. And a lot of that has been driven by this student loan repayment portion. So, with those payments set to resume here very shortly, we think you're effectively going to see a reversal in this chart, which means that there's been a fair amount of across the board adverse selection from a lending standpoint. If we go to the next slide and we just think about concentration levels,
Oi!
student loan borrowers holding about 14% of student loans, but a little bit more broadly, you've got 12% of borrowers holding roughly 47% of student loans. So just to put this in a little bit more sort of tangible terms, slide 35, this is
Roman society was civilized. Germany was still a tribal society. The Romans studied the German tribal society, so we know a lot about how it functioned. But anthropologists find that every tribal society they come across also has this Vergel tradition. If you cause an injury to someone else, okay, either, whoops, killed the guy, a fine is imposed on you. And you have to pay a fine to the victim's family. Okay? These fines were in kind. It would depend on what the injury was. That would determine what you had to pay, whether it's a goat or a cow or a horse or a sheep or a chicken. Oh, as far back as there was tribal society and humans came out of tribal society, so it's as old as humans. Okay, when did they come up with the idea and why did they come up with it? We don't know when, but it's obvious why they did it. To stop blood feuds. Otherwise you have the Hatfields and the McCoys killing each other. So this is to stop retribution. You had to pay a fine. So Grierson's notion was that the concept of valuing things came out of the Vergil tradition. It was a huge jump because Vergil, you pay a cow versus a chicken, depending on the damages you had done. Money allows you to compare those things. Oh, a chicken, it takes 100 chickens value to equal 1 cow. He thinks that's where money came from. It's a big intellectual jump, bigger than any measuring jump we had ever done before, because the measurements before money always were length. What's the length? Foot. Whose foot? The king's foot. Okay? Or cubit and so on. Those are relatively easy. Now, a hint is that every ancient money unit was the name of a grain weight unit. Shekel, lira, pound, those are all weight units. They all came out of measuring grain. So someone had the idea, let's use the grain measurement in order to measure the value of everything. By Babylonian times, this is exactly what they did, and then the price list, the equivalence to the mina, which was a grain weight unit, was posted at the temple. That is how you knew the value of everything. It was set by the temple's authorities. I'll come back to religion, because it's important for money. Okay, alternative, what is money? Yeah, I will. It is a state monopoly. It is a social unit of measurement. If you're in America, you can point to anything and ask people, what is that worth? They're not going to tell you in terms of chickens. They're going to tell you in terms of dollars. Almost everything can be valued in terms of dollars. Now, not quite everything, but as capitalism develops, a greater and greater range of things are measured in terms of money. It is a state money of account. Almost without exception, the money unit of account that we use comes from the state. Every time a new country is formed, it chooses its own money of account. Why did we get the dollar in the US? Because we didn't want the pound. Okay? We just revolted. We chose the dollar, and we modeled our currency after the Spanish currency to thumb our noses at England. And then we have money records. There's a hierarchy of these IOUs denominated in the state money of account. There is bank money, okay, and there are your IOUs. They're all denominated in the US dollar in America. The form that they take depends on technology. I'll come back to this. Paper money, coin money, electronic money, that is just the technological way of recording. The tally sticks, it might seem like that's a pretty primitive technology, but actually the tally sticks were a very advanced technology. It was hard to counterfeit. The problem with early coins and early paper money was counterfeiting wasn't all that hard to do. Counterfeiting was a tremendous problem when paper money started to be used. Okay? A lot of the technological advance is to reduce counterfeiting. What backs up our money today? When I first started teaching, the majority of the students in the class would say gold. Now this was in the early 80s. Okay. We had gone off gold under Richard Nixon. So it was already a decade that we had completely abandoned gold. It wasn't true then. Today, students rarely raise their hand because they all listen to Ron Paul, who wants to go back to gold, and they know that we're not on gold. Okay, so now it's very obvious. So I like to take the notes out and read what it says on the note. Okay, and probably you've all seen this on dollar bills. It says this note is legal tender for all debts, public and private. Canadian dollar, Australian dollar. They all say virtually the same thing, so a lot of people say, oh, it's legal tender laws. But you know that that's false. Okay, when it says it's legal tender for all debts, public and private, many times your cash is refused. They say, no, you don't take cash. Right, so it's just not true. And there are plenty of currencies that never had legal tender laws. What does the British pound say? Well, they don't have pound notes, so you have to look at a £5. This is a picture of the Queen, and this is what she's telling you. I promise to pay the bearer on demand the sum of £5. What does that mean? You take a £5 note to the Queen, she will give you a £5 note. That's what it means. It's £5. Okay, that's all it says. The older people will remember who this is. Alternative. The use of the currency and value of money are based on the power of the issuing authority, not on the intrinsic value. Okay. The currency does not have to have any intrinsic value. It's based on the power of the issuing authority. The currency itself is a record of debts, whether it's printed on paper or stamped on a coin. It's a record of a debt. It is a promise to redeem, and I'll say more about what redemption means. The state played the central role in the evolution of money from the very beginning. It always has played the central role. What we typically find when we look around the world today, and we look back as far back as we can go, about 5,000 to 6,000 years into the past, what we find is the one state or one nation, one currency rule. Each nation or state has its own currency. When the Soviet Union falls apart, every one of the former members chooses its own currency. Okay? In the past, the exceptions to this rule were extremely small and virtually irrelevant. The Vatican State used the Italian lira. Okay? That was an exception, minor. The only major exception to this rule is Euroland. It was an experiment in an exception, and it's been disastrous. Okay? Before the euro, this is what we find. It's not a coincidence. It's tied up with sovereign power, political independence, and fiscal authority. This is why every new nation adopts its own currency. And finally, taxes drive money. Taxes are what gives value its money. It is the power to impose taxes that is the important sovereign power that ensures the currency has value. I'll say more about this too. Okay. You don't have to take my word for it. You can take the written records at the time. Okay? Let's look at the colony of Virginia. The colonies were not allowed to coin. The colonies had to use the crown's coins. Okay? The colonies were always short of money in order to hire the armies to fight the Indians and the French Canadians. So they started issuing paper monies. Okay? Paper money was created and directly spent by the legislature. Every paper money included a new tax. So when they passed a law to authorize printing 10,000 pounds, Virginia pounds, they also imposed a tax that they expected would raise 10,000 pounds. They imposed the tax at the same time that they issued the notes. Now, why would they impose a tax? Because it created a demand for those notes. The colonial regular people had severe shortage of coins too. They couldn't have paid the new tax with the coins. There's not enough. Now, they were allowed to pay taxes with coins. Of course, the Virginia colonial government was glad to have the coins, okay? But they typically paid most of the tax in the form of notes. When the colonial legislature received the tax revenue, what did they do with it? They burned it. They did not spend their tax revenue. They burned it. So as the notes come in, they burn them. What did the King of England do when the tally sticks came in tax payments? Burned them. You always burn your tax revenue. You do not spend tax revenue, you burn it. In fact, they finally outlawed the use of tally sticks in England in around 1840. All the tally sticks were brought in, and the people at the Exchequer, which is the Treasury, the IRS, they were so glad they didn't have to use tally sticks anymore, matching them. They threw them all into the stoves at the same time. They burned down Parliament. There's a very famous painting of Parliament burning down. It's because they burned the tally sticks. Okay, anyway. So anyway, the revenues received were burned. The notes that were not received remained out and were used in the markets and actually were preferred over the coins. People preferred to use the notes rather than the coins. Okay, the taxes were paid in notes or specie. About 3/4 of the taxes were paid with notes and 1/4 were paid with the coins. This tax that was imposed by the legislature when they issued the notes was called a redemption tax. It was called a redemption tax. Okay, that's written right into the law. They knew what they were doing. The purpose of the tax is to redeem the notes. It gives a demand for the notes, and then the notes are brought back and burned. That prevents them from causing inflation. The purpose of the tax was to get most of the notes out so there wouldn't be any inflation. Adam Smith, 1776, wrote about this. You know, there's a strange thing going on in the colonies. They're issuing paper money, but it retains its value as long as they don't issue too much of it. Okay, so you use the taxes to make sure they don't stay out there and cause inflation. Another example. This one's a little bit different. Okay, this is the Yap Islands, and economists use this as an example all the time of primitive people using money that is a commodity. So they decided to use these stone wheels as money to reduce the transaction costs of barter. Nobody's laughing. Here's how tall they are. Here's their coin. When you want to go to the market to buy a fat pig, you have to get 10 strong guys. You put a log through here, you pick it up, and you carry it to the market, and you buy a pig. That reduced the transaction costs. It turns out on the Yap Islands, they don't have any stones like this. They have to get their dugout canoes, they paddle across open ocean 200 miles to go get the stone. They carve it, they put it on the canoe, and they try to paddle back. And a lot of the stones, the canoe flips over and they end up on the bottom of the ocean. But when the Yap Islanders consider their wealth of stones, they include all the ones that fell on the bottom, because it doesn't matter. They know they still have them. I mean, they don't have them on the island, but they know where they are, more or less. They can't get them, but it doesn't matter. Okay? So anyway, economists wrote this up as, this is primitive money. Okay. They don't tell you the second part of the story. So the Germans are trying to colonize the Yap Islands. The Germans want some roads built. So they go to the island, and they say, hey, we need the road built. We'll pay you currency to build the road. And I don't know what the German currency then was, but let's say it's the mark. We'll pay you 5 marks an hour to build the road. The Yap Islanders look at them like, you want me to work for pieces of paper? And of course, the Germans look at them like, they're great. You guys are so lazy. You won't even work for money. Okay? So they wouldn't work for the German currency. So some bright colonial governor said, I know what we'll do. Go through with a can of black paint and paint a big X on about half of the stones. So that's what they did. So they go through, they paint a black X. And the islanders say, what's going on? Say, well, we tax those. Okay, those are ours now. I say, how can we get them back? I say, well, you can build a road. So they reversed the sequence with a tax. The tax turned these into money. They were not money before. They were what we call primitive valuables. All tribal society has primitive valuables. They're usually things that are completely useless, and that's on purpose. And then they attach great ceremonial value to them. Okay, so this is a typical tribal thing that Europeans could not conceive of, so they thought they must be money. But they were turned into money only by a tax that the colonial government put on them. Okay, again, you don't have to believe me. Here is Beardsley Rummel. I'm not going to read the whole quote. Beardsley Rummel was an extremely important person. He was the chairman of the New York Fed. The New York Fed used to be called chairman, not president. Okay, that was to indicate how he was more important than the chairman of the Fed. Okay, still is, but we pretend like it's Janet Yellen. Okay. So anyway, he writes an article at the end of the war, and the title of the article is "Taxes for Revenue is Obsolete." We do not need taxes for revenue. We need them for other purposes. We need them to fight inflation. We need them to change people's behaviors. We tax cigarettes and so on. We don't need them for revenue purposes. He says that is what the war taught us and the people. Okay? How did it teach us that? We were running budget deficits of 25% of GDP with no negative impacts on the economy at all. Okay? Here's an exchange between the head of the Fed, so this one is the chairman of the Fed, and Wright Paxton, who was an important representative. During the war, the Fed bought lots of government bonds to keep the interest rate near zero. Okay, and so here's what happened. How did the government, how did you, the Fed, get the money to buy those $2 billion of government securities? $2 billion sounds like little now, but it was a lot back then. We created it. Out of what? out of the right to issue money credit. And there's nothing behind it except the government's credit. Well, we have the government bond. That's right, that's government's credit. In other words, the only thing you have is another government debt. Okay? So we've created money that is a government debt, and all that stands behind it is another government debt. So they go on. Do you believe that people should pay their debts generally when they can? I think it depends a good deal upon the individual, but of course, if there were no debt in our money system, there wouldn't be any money. Whoops, sorry, I'm going to show you. There wouldn't be any money. Mr. Patton, suppose everybody paid their debts. Would we have any money to do business on? Okay, and of course the answer is no. If everybody repaid their debt, there would be no money. Mr. Eccles says, he sees what direction he's going. He says, that's correct. In other words, our system is based entirely on debt. Okay, yes, it is. Or finally, here's Bernanke. The Fed lent and spent about $34 trillion to save Wall Street. $34 trillion. He was interviewed on 60 Minutes. Is that tax money the Fed is spending? You notice it's virtually identical to what was asked at the end of World War II. It's not tax money. We simply use the computer to mark up the size of the account. If they have somebody at the Fed who has a finger, that is how they do it. Keystrokes. It's just keystrokes. That's how you do it. Okay. I think I'm going to skip over some history of thought here. Implications. Fiat money is not worthless. It's valuable due to the state's promise to redeem it in payments to the state. You can find this in the economic literature. The very best place to start is with A. Mitchell Innes, who was the Queen's ambassador to Washington. He was an autodidactic. He wrote something on beekeeping, and then he wrote the two best articles ever written on money. Okay. How he figured it out, I have no idea. Keynes reviewed it and said, we might quibble with some of the details, but the argument is sound. Okay? Money and debt are linked. Debts are denominated in the state money account. My professor Minsky used to always say, anybody can create money, the problem is to get it accepted. Creating money is a matter of writing, I owe you $5. Your problem is to get somebody to accept that. Now banks have an easy time, you have a harder time. All monies are created as liabilities of the issuers, and here's the key point that Innes makes. All issuers must accept their own liabilities back in payment. If you refuse to accept it, you have defaulted. Why was the Bank of England created? The king defaulted on his tally stakes. One of the King Georges, I don't remember which one. He defaulted on his tally stakes. So they had to create the Bank of England because nobody trusted that king anymore. Okay, he refused to accept back his own tally stakes in payment. All money is credit money. The state money approach might appear to be inconsistent with the credit money approach, but even state money is credit money. The state's money is the government's debt, the government's IOU, and they must accept it back in payment. Redemption then means delivering an IOU in payment to its issuer. It doesn't matter whether the IOU is printed on a gold coin or printed on paper. It's an IOU. It doesn't need to have any intrinsic value or not, but even if it does, it is still an IOU. So sovereignty is a set of institutions. There are many other aspects of sovereignty, but the important one for money is that the sovereign has the power to impose fees, fines, taxes, and to name what it will accept in payment of those obligations to the state. When the fees, fines, and taxes are paid, the currency is redeemed. It's accepted back by the sovereign issuer. Some sovereigns also agree to redeem their IOUs for gold when you're on a gold standard, but that's not necessary. Now, we know it's not necessary because we gave it up a long time ago. Let's go twist that. So, in almost all religions, debt is a sin, but being a creditor is an equal sin. Okay? So you're sinful on either side of the equation. The debts are paid by delivering back an IOU to the issuers. That is what we call redemption. These terms, of course, came from religion because money came out of the temples. So it's not a coincidence that many of the terms we use when we talk about money are terms we use when we talk about religion. So you can read this slide on your own. Which comes first, creation or redemption? You've got to create first before you can redeem. If you aren't in debt, you can't redeem yourself. Redemption can't come first. Debt has to come first. Government has to spend first, which is getting the government itself in debt, before the government can redeem itself, collect back in taxes. The colonial governments had to spend the notes before they can collect them. They have to be in sinful debt before they can be redeemed. This is true for everybody. Government, bank, household. You can't redeem your debts until you have created the debts. So how does the government really spend? Okay. Things are more complicated than they used to be. Our government does not spend paper money into existence. The paper money is issued only because you go to an ATM machine and make withdrawals. Our government doesn't spend the way the governments always had spent in the past. Why? Because there are two things in between you and the government. One is your bank, and the other is the government's bank, which we call the central bank. Okay? So you are, 3 degrees of separation away from the government. The government imposes a tax on you, but you pay taxes by writing a check or an electronic deduction from your bank account. The central bank deducts your bank's reserves and credits the Treasury's account at the central bank. When the Treasury wants to spend, it cuts a check. When you deposit it in your bank credits your account, sends the check on to the Fed credits your bank's reserves, and then debits the Treasury's account at the central bank. Okay? So it's more complicated, and it's more complicated than that, because we have a whole bunch of what are called tax and loan accounts, special depositories, and so on and so on and so on, that complicates the procedures and makes it a lot harder to see how things actually work. But the logic remains, it's still the same. You can't deduct reserves from banks unless they have them. They can only get them from the government. So the government either has to spend or lend the reserves before the banks can have their reserves debited when you make your tax payments. All the logic remains. One of the first things that MMT did was to get into the details of how everything operates today, which I can tell you no economist knew. None. Before we looked into it. Now, of course, there were people at the Treasury and the Fed who knew because they had to do it. But academic economists had no idea how the government really spends. Some of our earliest articles 20 years ago were, how does the government really spend? So we have gone through all the details, and we've done it for other countries too. And it's the same. Okay, I mean, minor detail changes, but otherwise it's the same. Policy implications. Government cannot go bankrupt in its own currency. It can issue more through keystrokes. It can make all payments on government bonds through keystrokes. Okay? You don't take that money away from taxpayers, as Bernanke explained. How did they spend and lend $34 trillion to save Wall Street. It was all keystrokes. There is no limit. The government can always afford to buy anything for sale. If there are unemployed people around, the government can always afford to get them jobs and pay their wages. The only economic constraints government faces are full employment resources. Once you've employed all of them, okay, except for imports, the resources are already all used. And any further spending will be inflationary. Okay? So full employment and then an inflation constraint. Other constraints are political. So, during the global financial crisis, Obama comes in, okay, and things are getting worse and worse and worse and worse. And Obama wanted to spend more. Okay? We finally got a fiscal stimulus package of $800 billion, which was $400 billion spread over 2 years. Okay, $400 billion and then $400 billion. Any economist who studied the economy, other than extremely ideological ones, knew that wasn't enough. Obama knew it wasn't enough. So he goes on TV, and what does he say? We're out of money. We would like to do more, but we ran out. Okay? We're on an unsustainable debt path. Okay, this is what many economists were claiming. We got to borrow from the Chinese. We ran out of money, so we got to get the dollars from Beijing, which is ridiculous if you think about it. All dollars came from the United States. We'll become Weimar or Zimbabwe, hyperinflation. Look at Euroland, that could happen to us. We'll be just like the next Greece. Burden our grandkids, all this stuff. All of this is false. It's absolutely false. Okay? None of this could possibly happen. Paul Samuelson, who was the most important textbook writer for your grandparents, was interviewed in 1974. It's a very interesting interview. You can find it on the web, interviewed by Mark Blau. It says, I think there's an element of truth in the superstition that the budget must be balanced. Here he said at all times, but later in the interview he's talking about balancing the budget over the cycle. And he said, it's like the old-fashioned religion was to scare people by sometimes what might be regarded as myths. So the purpose of these kinds of statements is to scare you. That is the purpose. It's not true. It's a superstition. It's like old-time religion. We know it's not true. But economists are in the business of dishonesty. Because we got to scare you. And this Paul Samuelson was the greatest, according to many, greatest economist. Here's the St. Louis Fed. St. Louis Fed is the second most conservative Fed in the United States. It's the home of Milton Friedman's monetarism. Here's the St. Louis Fed. I won't read it all. You can read the quote. And what they say is the government can never run out of dollars. It can never be forced to default. It can never be forced to miss a payment. It is actually never subject to the whims of bond vigilantes. All of that is false. This is the St. Louis Fed. Greenspan said the same thing. When he was asked, will Social Security really go broke? He said, no, of course not. The government has this thing called a printing press. Okay? We don't use a printing press. He should have said, we have this thing called the computer, and it has keys on it. We can't run out. King of France. I'm going to have to skip the second, which is very interesting, but let me conclude. So there are two views on the origins, the origins of money story that you adopt tells you what you think the nature of money is. Okay? Do the orthodox economists really believe Robinson Crusoe's story? Probably not. They tell that story because it focuses your attention on what they want you to focus your attention on. The idea of markets and money as a medium of exchange. Okay? The alternative to that is a social relations story, variegated debt, role of the authorities, choosing a money account, the state money, the currency, and taxes drive money. Again, the story of the origins, we don't know this, the truth, okay? But Vergel focuses your attention on debt, okay? It's in the nature of money that it must be debt. There's a movement now called debt-free money. It's a non sequitur. It's impossible. Money is debt. Bitcoins are not money. Can't be money. Money is not primarily a medium of exchange. Money is a state monopoly, unit of account, driven by obligations to the state. Typically, now it's taxes. Banks make payments for their customers and bank IOUs that are denominated in the state's money. Deficit spending creates financial wealth. That's the part I didn't get to do, the sectoral balance approach. And a sovereign cannot run out of its own IOUs. So I'll stop there and hope we have time for questions. Money is a debt denominated in the money of account, and it's almost always a state money of account. Even the few possible exceptions to that, it is still a socially determined money of account. Now you could choose your own money of account. Say, my money of account is Glocks. Well, the problem for you is you got to get other people to accept it, right? Having your own idiosyncratic measure of value is not going to be accepted. So it comes from the authorities, and since the development of nation states, it always comes from the nation state. Even if you are a country, say Ecuador, that adopts the US dollar, you're still choosing a national money of account. You've just chosen to give sovereignty to the US rather than to your own country. Once you reach full employment, if you continue to increase government spending, you're going to be trying to bid resources away that are already employed. And if the private sector can match you, then you get into a bidding war. And you will drive up prices. You can cause inflation. In fact, and you will cause inflation if you reach full employment and you continue trying to increase spending. You can get inflation before full employment, something that Keynesians didn't realize in the 60s, depending on what you're spending on. Okay, so whether there's 6-8% unemployment out there, but if what you're doing is picking off, say, the high-trained engineers and so on, you can cause inflation long before you get those 6 to 8% employed, because they don't have the skills the government is hiring. So you can get inflation even before full employment. Okay? So we admit that. I mean, and we warn about it. That's what Beardsley Rummel was saying. Okay? Taxes are to fight inflation. So if you're going to continue to increase government spending, you also need to raise taxes, because what the taxes will do is reduce the private sector's ability to compete with you. So what do you do in wartime? You raise taxes, you try patriotic saving, you put rationing on. All of those are to prevent inflation. We know how to do it. Now, there are no cases, zero, of modern, developed, capitalist countries using their own currency who get hyperinflation. Zero. Hyperinflation is an extremely rare phenomenon, and you can list the 3 of them, okay, that have happened that everybody knows about. So everyone is worrying about something that is extremely rare, and when you look at the causes of the hyperinflations, it had nothing to do with government deficits. What was Germany's problem? War reparations and the seizure by France of most of their industrial sector. So they had to make reparations. They were not able, they would have had to export almost all of their output in order to get the pounds and gold they needed to make the payments. Okay? So they did print money. But they already had these conditions put on them. Okay, so now the government, of course, is worried about the population, and the government needs to make the payments. So a deficit resulted because of this. If you look at the deficits, what the government is trying to do is to keep up with the rate of price increase. Because when you have high inflation, your tax revenue will never keep up, because taxes are always calculated after the fact. And if prices can go up by 100% per day, and your taxes are collected maybe every quarter, by the time you're collecting taxes, it's on income. that is in a currency that was, 10 times more valuable than it is today. So a deficit will result in those conditions. When you look at Zimbabwe, what you find that this was a result of a collapse of their agriculture, because they had possibly very good intentions of land reform. They put the land into the hands of people who could not produce as much output. So it was a collapse of supply. In both of those cases, really, it's a collapse of supply, because the production had to go to pay war reparations. Keynes wrote about this right at the end of World War I. He said, if you the Allies put these payments on Germany, okay, they can't possibly make those payments. And his first famous book, and he was absolutely right. So it was predictable, and it was foreseen what was going to happen. Okay, so the hyperinflations are evidence of other problems. They are not evidence of budget deficits. Budget deficits will occur just because everything the government is buying is going to be going up in price at the rate of inflation, and the tax revenue lags way behind. So, in the United States and every country I know of, we have a budgeting process. What does the budget do? It puts limits on the spending. Now, some kinds of spending are a bit more open-ended, because if it's unemployment compensation, you can't predict exactly how many people are going to be unemployed, and in a downturn, that spending will go up. But it is limited because the people have to qualify, right? Something like 1/3 of American workers will qualify for unemployment compensation if they lose their jobs through no fault of their own. And so it's limited by that. There's always a limit. Okay. In addition to that, the U.S. alone has an absolutely crazy limit. It's called the debt limit. We're the only country that does this. Okay. That one, in the past, never proved to be a limit, because Congress always raised the limit. Every time, routinely, they would just raise the limit. But then the Republicans decided they could get a lot of political capital out of postponing the approval. So they could make, even though you've already budgeted all the social programs and they agreed to the budget, they think they get a second chance to get rid of some social programs that they don't like. So they always try to do this. So it became a political issue. But yes, you need limits, okay? And if you're moving into a situation where the government is going to need a lot more resources, so typical, it's war. But it wouldn't have to be war. Let's say that Trump was serious when he proposed infrastructure. Okay? Well, now, if the government is going, and we need about $3 trillion just so we have safe infrastructure. To catch up and keep pace with the Chinese, it's probably more like $5 or $6 trillion. Now, if we were to go out in a campaign to do what China is doing, we're going to be bidding away, the whole construction sector of the economy in order to try to catch up to China. That's going to be very inflationary. So we would have to put rationing on the private sector. Say, sorry, no more Trump Towers, because we're going to do infrastructure now. So you would have to ration it. But it wouldn't have to be war. Let's say that Trump was serious when he proposed infrastructure. Okay? Well, now, if the government is going, and we need about $3 trillion just so we have safe infrastructure. To catch up and keep pace with the Chinese, it's probably more like $5 or $6 trillion. Now, if we were to go out in a campaign to do what China is doing, we're going to be bidding away, the whole construction sector of the economy in order to try to catch up to China. That's going to be very inflationary. So we would have to put rationing on the private sector. Say, sorry, no more Trump Towers, because we're going to do infrastructure now. So you would have to ration it. All right? But the fact is that outside of World War II, the U.S. has never been close to capacity. Never. We have never had a problem of excessive demand. We've never even had a problem in the labor markets. In Europe, possibly, they achieved full employment and did get inflation because the labor markets were too tight. US, we've never had that. We've always had plenty of unemployed people, okay? So what you had to do was target your spending. Because if you spend all of it on aerospace and military, you'll cause inflation long before you run out of resources. You just run out of the kind of resources you're buying. We always could have spent more government money, but we needed to target it at the unemployed, not targeting at the most unionized workers with the highest skills and the highest pay, which is what we always did. So everything I said about modern money theory applies to every country in the world that issues its own currency and doesn't peg its exchange rate. Everything I just said applies to them too. Virtually every country in the world has a big government debt. Ours is not big relative to many other countries in the world. Okay? Japan's was 3 times bigger. Ours is growing maybe 2.5 times bigger than ours relative to the size of the economy. Ours is not big. Americans have this conception we have a big government debt, but it's not true. It's because the media and Republicans harp on this all the time, but it's just not true. So why don't we do more? I think is the right question. All of us should do more. The countries that don't have big government debts and budget deficits are exporting countries. Exporters can get away without government deficits. The reason is because they get their demand from other countries. So China, their central government can run a balanced budget. Okay, Singapore can run a budget surplus because their demand comes from abroad. Okay, and that keeps their economy growing even though their government is actually draining the economy. So that is the only exception. If you are a current account surplus country, you don't need a budget deficit. But all other countries have them. We actually were going to subtitle ours, we're not doing it, a government-centered approach. Because every other textbook, the government comes in chapter 10, right? It's pretty bizarre because the government is by far the biggest entity in the economy. By far, nothing comes close to the size of the government. Okay, and the government is the issuer of the currency. And you wait till chapter 10 to tell the students, oh, by the way, there's this thing called government too. Yeah, that is very bizarre. Of course you should start with the government. It's got to be there in chapter 1. It's the most important thing about our economy. Although everyone says, well, look, now we're a free market capitalist now. The governments of capitalist economies tend to be much bigger than the governments of pre-capitalist economies. The capitalist economies need big governments. It tends to be true that as you go down, when you rank countries by size of government, as you go down, when you get to the ones with governments smaller than ours, they do not work well. So Mexico has a government that's about 13% of the economy. Is Mexico a more successful economy than the United States, which has a federal government at about 20 to 25%? Almost twice as big. No. France has a government that's 15% of the economy. France used to work pretty well before they gave up their currency. So anyway, the governments of capitalist economies are big, and there's a reason for it. Medieval European governments were tiny, tiny little things. Now there are exceptions. Well, I don't really have an opinion on that. You see very well performing economies in the United States until about the mid-70s. Performed very well, and it was the biggest economy in the world. It performed very well. The Chinese economy now started from very, very poor, underdeveloped. I don't know how many of you have been there. It is absolutely amazing what you see. That's why I say we need 6 trillion of infrastructure. We're going to be left so far behind. So I don't know. Small economies, some small economies also do very well. So I'm not sure that it's an economic issue. It might be a political issue. It might be that you can get more cohesive politics when you have small economies, small nations. Maybe it's not an economic factor, it's a political factor. Most are not there anymore. Not anymore. 10 years ago. No, but they are developed further and further west. You land in a city, I'm not talking about the far west, but well away from the east. And the city's a few years old, and it's 8 million people, and you've never heard of it. And they've got subways, and they've got, when you fly in, it makes Manhattan look tiny with tiny little buildings compared to what they will have out in the middle of nowhere in China. They are transitioning. So I think they have about 40% are rural, and they tend to be older. And China has decided that they can provide much better services to the elderly if they get them out of the rural areas. So there is a transition process, and they have not figured this out yet. I know. My wife is Chinese. I go to China all the time. I see the problems you're talking about. China has big problems, and they're trying to solve them. I was focusing on how quickly they have developed from, horse carts to now you go to a train station and they have 25 bullet trains sitting there ready to go. Everyone is full always. Always. In fact, more than. And they're going 300 kilometers an hour. Train stations, airports, there's nothing like this. If you've ever used JFK, and then you go to Beijing, which has 3 airports, you will be absolutely amazed. And yes, who is flying in China? It's about like the way the United States was 20 years ago. Yeah, you're talking about people with more money and educated. You go to the center of cities and everybody's driving cars that are $100,000 because they cost twice as much there. But they're all luxury cars. Inflation in the U.S. is under 2%. Now, for seniors, let me finish. For seniors, inflation is higher than that. Okay, Social Security, the COLAs are not taking account of the prices seniors pay, and they need to adjust that. And the lower income, so Social Security is based on your income over your working life. At the lower income levels, the Social Security that you will get at retirement is not nearly sufficient. And those are problems. Can we solve those? Of course we can. Is it affordable? Of course it is. So what I am telling you actually gives you the solution. If you take the orthodox approach, there really is no solution because they believe we're very constrained. We have to take more from working age people and young folks to take care of the retirees. They have created this whole story of intergenerational warfare. They're trying to turn young people against Social Security, saying, you guys will never get it as good as old people now. Social Security is going broke. We would have to raise your taxes to 25%, just the payroll part, in order to take care of seniors. It's all false. Completely false. We don't have to do any of that. The only thing that really matters is our productive capacity. If that grows, young people today will have a better retirement than people are now. Okay? As long as our productive capacity continues to grow. If it grows at a normal pace, their standard of living should be between 2 and 4 times greater than retirees today, without any changes to Social Security. just making the commitments we already promised to them. All right? But we got people running around trying to tell all the young people that Social Security is a bad deal, we need to get rid of it, they should have their own private retirement plans, okay, so they can lose all their money in the stock market and end up living in poverty in their old age. Okay? That's the mainstream story. My story is completely different. Affordability is not the issue. Okay? Productive capacity is the issue. And by not spending now, we will not have the productive capacity in the future. If we continue to just let everything deteriorate, we won't be able to take care of seniors in the future. I think Martin needs to talk.
Welcome to the International and Comparative Law Center Seminar Series 2015. We're absolutely delighted today to have with us Professor Randall Wray, not only Professor of Economics at the University of Mississippi, Kansas City, but also Senior Scholar at the Levy Economic Institute of Bard College. Has a lot of accolades from the past. You can go on Wikipedia if you would like to find them. Today he's going to be talking on money market theory, intellectual origins, and policy implications. And I would encourage you, if you're interested in that, you can find that in the Palgrave Dictionary, as well as check out his primer on money market theory that came out in 2012, and I believe got reissued in 2015. So without further ado, Professor Randall Wray.
Okay, well, thanks for the invitation and for you coming out. I guess we first started talking about this 4 years ago. It took a long time to arrange to make it here. And what I circulated was an entry I wrote for the new Palgrave Dictionary of Economics. The idea is to sort of summarize modern money theory for a general audience, not strictly for economists. And first, I'll just tell you a very brief personal history of this approach to economics. It began in the early 1990s when the internet was relatively new. Again, we were talking earlier, Al Gore had invented the internet, as you know. A discussion group online was created, maybe one of the first, maybe the first, I don't know. It was called Post-Keynesian Thought. And post-Keynesian economics follows John Maynard Keynes, and it's what we call a heterodox approach to economics. It's outside the mainstream. But all the top heterodox economists around the world were on this discussion group. And this guy came on, and he started saying things that on the surface seemed very strange, very bizarre. But as I read his comments and thought about them, I could see that he was just using different terminology. That a lot of things he was saying existed in various branches of heterodox economics. And so online, he would say things, and most people would respond, "This is crazy." And then a few of us sort of started catching on and said, "Oh yeah, that sounds like, okay, Hyman Minsky. That sounds like George Frederick Knapp," and so on. And so he started communicating with us. And one of the ideas he had that became very important to opening up this new approach to economics is he was a hedge fund manager who specialized in trading bonds. And sometime in the early 1980s, he said, you know, the Fed sells bonds. We call it monetary policy. It's called open market operation. And the Treasury sells bonds. We call that borrowing.
we say it's part of fiscal policy, is that functionally they are identical. They're the same operation by the government, just two different branches, the central bank branch and the treasury branch. But for the non-government sector, the impact is exactly the same. Okay? And so when he wrote that, it just opened up our minds. We say, we've been looking at government finance wrong. Okay? And virtually all economists have got it wrong. So I'll come back to that, explain why this was so important. He wrote a little, a thick pamphlet called Soft Currency Economics. That was the first publication that started to lay out this approach to economics and specifically to government finance. And then I wrote the book that John mentioned, Understanding Modern Money, in 1998. That came out. And so that was the first academic publication of this approach to economics. And we used to meet every year with Warren, and we would say, how many people now understand what we're talking about? It took about 5 years to get up to the fingers on one hand. And 10 years we were up to, we had to use both hands. Okay. It was very rough going, very slow. Until the blogosphere. Now, just when you go home tonight, Google modern money theory. You're going to get literally millions. There are thousands of people around the world, most of them not in academics, okay? Vast majority not economists, who could give a pretty good summary of what modern money theory is all about. So, and there actually are political movements now that call themselves modern money theory. For example, in Italy, actually there are several rival political movements that all call themselves modern money. Which we might as well talk about. So anyway, what I'm saying is just it took off with the blogosphere. And in 2012, I wrote a book I called The Primer. So it's a modern money primer, where I tried to explain it to a non-academic audience, and that has been updated for 2015. And I'm told the book is out. I don't have a copy because they mailed them all to Kansas City. But I think it is now for sale. Let me first summarize the basic conclusions. Then I'll very briefly go through what we call history of thought, that is, the intellectual origins of the ideas. Because actually, most of what's in modern money theory is not new. It was just forgotten. It was lost. It was lost over the past 40 to 50 years. It got lost. And then finally, the policy implications. So I don't remember how many points there are, but just these are the conclusions where the theory takes us. The first is that sovereign governments issue their own currency, and this makes a big difference. A sovereign currency issuer can behave much differently from a sovereign currency user. You guys are all users. Okay? Uncle Sam is the issuer. It makes a big difference, whether you're a user or an issuer. The sovereign government chooses the money account. In the United States, we call it the dollar. In Canada, confusingly, they call it the dollar. In Australia, they call it the dollar. In the UK, they call it the pound, and so on. The unit of account. The sovereign then issues a currency denominated in the same unit of account. So in the United States, confusingly, we call little green pieces of paper dollars. Okay, we use the same term. Well, one is the currency. The other is the unit of account. They impose taxes in the same currency. Okay, so you owe dollar taxes. They accept their own currency in payment of taxes. Okay. In the old days, you actually would deliver the currency to pay your taxes. Nowadays, mostly you do it electronically, or maybe you write a check. Prices generally are denominated in the same money account. Maybe not all prices, but most prices, most of the time. Contracts are written in the same money account and enforced in courts in that money account, usually, not always. When you have a sovereign currency, there is a spectrum of exchange rate regimes that you can choose among. And what we argue is that a floating exchange rate provides the most domestic policy space. You can manage your exchange rate, which is what China does. And that might reduce your domestic policy space. You can peg your exchange rate, which many countries do, they peg to the dollar. That further reduces policy space. You can adopt a foreign currency as your own currency. Some countries have dollarized. So Ecuador adopted the US dollar. That severely constrains domestic policy space. You can adopt a gold standard. You can adopt the euro. Okay. Those reduce your domestic policy space. So if you want to maximize your domestic policy space, you adopt your own currency and you float. That will provide a maximum domestic policy space. The problem with fixing your exchange rate is that you need the foreign currency that you have fixed to. Or if you're Ecuador, you actually need to get US dollars. That constrains your domestic policy space because you have to operate your economy in a way that ensures a flow of dollars into your economy. Usually this means what you want is a trade surplus. If you want a trade surplus, you usually have to adopt some form of austerity. You have to keep wages low. You have to keep domestic aggregate demand low so that your population won't buy imports because you're trying to run a positive trade balance. That's why it reduces your domestic policy space. Now, a country like China today has an unassailable foreign currency reserve, $3 trillion of foreign currency. Even George Soros will not attack them. Okay, and part of the reason why they've accumulated that amount is because George Soros attacks countries that peg and don't have enough foreign currency reserve. George Soros brought down the United Kingdom. One guy brought them down. They had to abandon their peg. Okay? So that is the danger, and that is why your domestic policy space is reduced. You can't pursue things like full employment policy, because full employment could lead to your wages rising and could lead to your population importing, which reduces your trade surplus. Someday, China will float their currency. Someday, China's trade balance will turn around, probably a lot sooner than what most people believe. Why? Because they are allowing their wages to rise. They actually have a policy of wage increases. And so they're not going to very long be a low-cost producer. So they will float their currency in order to protect their domestic policy space. That's a prediction. Economists are often wrong, but I think that is what we're going to see. All right. Finally, final topic on sovereign currency. If you issue your own currency, you can't run out. Uncle Sam can't run out of his own currency. He never needs to borrow his own currency. And in fact, if you think about it, borrowing your own currency would make no sense. It would be like you've written an IOU to your neighbor. I owe you a cup of sugar. And you find out you need another cup of sugar. Are you going to go try to borrow that IOU back from your neighbor in order to get another cup of sugar? No, you're going to write another IOU. Okay? So I'll come back to this, but sovereign countries don't need to borrow their own currency. In fact, there's no balance sheet operation that you can show me in which someone borrows back their own IOU. and this was Warren Mosler's brilliant observation. Bond sales are not a borrowing operation. They're something else entirely. So I'll come back to explain what that is. Now, sometimes countries borrow in foreign currency, okay? And you can borrow foreign currencies. Again, the problem with borrowing foreign currencies is that you have to pay back in foreign currency. And so that will constrain your domestic policy space. So I would say almost always it's a bad idea for governments to issue debt in a foreign currency, because that is similar to adopting a fixed exchange rate. You're going to have to operate your economy in such a way that you can get the foreign currency to service the debt. So it will constrain your policy space. Okay, the second point. Taxes drive the currency. This is a shorthand way of saying that sovereign government that chooses a money of account and issues a currency in that money of account needs to create a demand for the currency. The way they do that is by imposing an involuntary obligation on the population, citizens or subjects, depending on whether it's a democracy. They impose the tax or some other involuntary obligation in order to create a demand for the currency. Okay? Historically, the main obligations were fees and fines. But from the 19th century forward, taxes have become the most important obligation that you have to pay in your nation's own currency. From inception, if a government announces, we're going to have a new currency, we're going to call it the dollar. And here, I want to buy something from you with dollars. You would ask, well, why do I want the dollars? Okay. And says, because you have to pay taxes at the end of the year. Okay. The obligation is necessary from inception in order to drive the currency, to create a demand for the currency. Now, what we say is that taxes are a sufficient condition. They might not be a necessary condition. Sufficient condition means that if you have to pay the tax in dollars, you will demand some dollars to pay the tax. So we'll create a demand for the currency at least up to the amount of the tax obligation. Taxes might not be necessary to drive the currency. Okay, we can be agnostic on that. You might be able to come up with another explanation for why people would demand a currency, even if there was no obligation that they had to pay in that currency. I haven't heard any. The typical answer I get is the dupe-a-dope. Okay. Well, I accept currency because I think Buffy Bob will accept it. That's dupe-a-dope. I think I can pass it along to someone dumber than me. I'll accept the currency. That's the typical explanation for why people accept US dollars. We can dupe dopes with it. Okay? That's not satisfying. I think the reason we accept dollars is because a lot of Americans have to pay taxes in dollars. But we can say that taxes at least are sufficient, and they might even be necessary in order to drive for the currency. From inception, you can't pay your dollar tax unless the government has provided some dollars. What this means is the government needs to spend the dollars so that you can pay taxes. In other words, the logic tells us that the spending comes before the government can collect the taxes. Because you can't pay your taxes until you've got the dollars. If the dollars come from government spending, the government needs to spend before you pay your tax. So logically, the government doesn't spend taxes. Logically, the government spends so you can pay taxes. The spending has to come first. What that means is taxes actually don't finance the spending. Now, of course, if the government has been spending for years and years and years, a lot of dollars can accumulate. in the hands of the non-government sector. Okay, and so that you have accumulated dollars that you can't pay taxes with. However, they all came from the government spending originally. So once we've developed a monetary economy and there's lots of dollars in circulation, then this logic becomes less apparent. You say, oh, saying, I have a lot of dollars, pay the tax. I don't need to wait for the government to spend. But the government had to spend from inception in order to get the dollars into the economy so that taxes could be paid. The sovereign government that the sovereign government that issues its own currency cannot be revenue constrained because it issues the dollars as it spends. If it wants to spend more, it issues more currency. It can't be revenue constrained. It can't run out of its own currency. It does face constraints. The main constraint it faces is the resource constraint. It can run out of resources to buy. It can push up the prices of resources. So, too much government spending can cause inflation, as people long argue. But it can't cause insolvency. It can't cause insolvency. It can't cause the government to run out. So the fourth point is, there is no solvency risk for a government that issues its own currency. There is no possibility of bankruptcy. When President Obama tells us that the U.S. government has run out of currency, he is misinformed. It can't happen. The U.S. government can always issue more. It's not possible to run out. There's no chance that running budgets, spending more,
Taste my fingers.
is going to bankrupt the United States. Can't happen because we can always issue more. We can always make all payments as they do. The second kind of constraint is that the government can put constraints on itself. The United States has a very bizarre constraint, the debt limit. Okay. No other country that I know of has one of these. So Congress imposes a debt limit on the U.S. government. And we've had this since 1913. Whenever we came up close to the debt limit in the past, Congress almost always, really without debate, raised the debt limit. So it never was an issue. It was a constraint, it was never constraining. Okay? A few years ago, the Republicans decided to make it an issue to try to enforce policy changes that they want by saying we won't approve an increase of the debt limit. So it became a big political football, and we're going to hit it again, okay, very soon. And so what I'm saying is you can impose a debt limit constraint, you can refuse to raise it, and you can force the government to default on its promise to pay interest on the outstanding government bonds and other promises. It can be forced to break its promise to Social Security recipients. Say, sorry, we hit the debt limit. We can no longer write the checks for your Social Security. But that's a self-imposed constraint. We can remove the constraint anytime. Congress can either raise the debt limit or just get rid of the stupid debt limit altogether and say, that was a bad idea. And it wasn't bad. And most other countries haven't imposed this kind of constraint. So what I'm saying is, you can impose constraints, okay, but the market doesn't do it. Okay. There actually is no reason why the U.S. government can't continue to spend and meet its commitments, pay interest to the bondholders, and pay Social Security payments to the retirees, simply by issuing a currency. Fifth, sovereign government doesn't need to borrow. In fact, really can't borrow its own IOUs. Some people think that the reason that the government is borrowing is because it needs to finance its deficits. But actually, the bond sales come after the government has deficit spending. The deficit spending creates what we call high-powered money, which is currency plus reserves. that is used to buy the government bonds. So this was the inside of Warren Mosley. Everyone knows that the reason the Fed sells bonds, which is currency plus reserves, the deficit spending creates what we call high-powered money, which is currency plus reserves, that is used to buy the government bonds. So this was the inside of Warren Mosley. Everyone knows that the reason the Fed sells bonds is to drain reserves out of the banking system. Okay? This is not controversial. Everyone accepts this. Okay? It's in every money and banking textbook. This is not controversial. It's to drain reserves out of the banking system. Okay? This is not controversial. Everyone accepts this. Okay? It's in every money and banking textbook. An open market sale is to drain reserves from the banking system. So Warren is sitting there and he's saying, but hold it, what happens when the Treasury sells bonds? It drains reserves from the banking system. Exactly the same. They are identical operations, just by different branches of government. And once he realized that, he said, then bond sales are not borrowing operations. It has nothing to do with borrowing. It has to do with draining reserves. Why do you need to drain the reserves? Because deficit spending means the government has credited more bank accounts than it debited. When the government spends, it credits bank accounts nowadays. When taxes are paid, the government debits bank accounts. That means if the government is spending more than taxing, it is net crediting bank accounts. It's increasing the recipient's bank account, and that bank's reserves at the Fed get credited. Excess reserves in the banking system drive the overnight interest rate towards zero. Excess reserves drive interest rates down. The reason the Fed sells bonds is to drain the reserves out so it can keep the overnight rate, Fed funds rate, on target. So the purpose of bond sales is to allow the central bank to hit its interest rate target. And it doesn't matter whether it's the Treasury or the Fed. The problem for the Fed is that normally it has a very small stock of treasuries. If the government is deficit spending, over the course of the year, it will be adding dollar for dollar reserves for every dollar of deficits. If you think back a couple years ago, the budget deficit was $1 trillion. A $1 trillion budget deficit will increase bank reserves by $1 trillion, dollar for dollar. In normal times, banks held about $50 billion in reserves. Adding $1 trillion means a massive amount of excess reserves. You have to drain them out. You do that by bond sales. Okay? So this is why the Fed has to coordinate with the Treasury and say, we need you to sell more bonds because we're running out. So the Treasury will sell bonds that drain the reserves out of the system because the central bank doesn't issue bonds. Okay? We could envision different ways of draining the reserves. You could have your central bank issue the bonds rather than the Treasury. The point is, it's not a borrowing operation. It's part of monetary policy. It's to allow the central bank to hit its interest rate target. Notice the logic here again is the spending comes first, then the bond sales. Spending goes first, then the tax receipts. The source of the currency is the government. The currency has to come first before you can collect the taxes or sell the bonds in order to drain the currency out of the system. Next point. Central banks are never really independent. They have to coordinate their operations with the Treasury. Okay, there are several reasons for this. One, I've just gone through. Every Monday morning, the Fed and Treasury talk. Okay? The Fed has a projection of what it thinks will be added to bank reserves. Okay? And this depends on how many people are going to cash their checks from the Treasury, how many welfare recipients and Social Security recipients, recipients will cash their checks this week, because that will lead to reserve credits. And how many taxes will be paid this week? You can imagine the week before April 15, a lot of taxes are paid. Okay, that means a lot of reserves will be drained out of the system. You might have to put some in, which means the Fed will buy bonds instead of selling bonds. Anyway, they have to coordinate their operations, because the federal government is by far the largest economic entity in the United States. Its impact on bank reserves is by far the largest of any entity. Okay? And if they didn't coordinate their operations, the Fed would be stuck with either adding or draining reserves to offset the Treasury by massive amounts every day, hundreds of millions of dollars every single day, in order to make sure banks have the right amount of reserves. The Fed is the Treasury's bank. Modern treasuries don't spend by bringing wheelbarrows of cash up to buy the stuff that they're buying from contractors. They don't deliver wheelbarrows of cash to your home if you're a Social Security recipient. They use the banking system. Okay? So the Fed is the link between the Treasury and the entire banking system. The Fed makes and receives all payments for the Treasury. The Fed is the Treasury's bank. Okay? And for that reason, it can't be independent. This idea that somehow the Fed will prevent the Treasury from deficit spending by saying, no, sorry, no money in your account today, we're going to bounce your checks, is not going to happen. Never has happened, never will happen. If the central bank started bouncing Treasury checks because of insufficient funds, the president will call in the Fed and tell them, stop doing this. You're messing up the payment system, okay, the credibility of the U.S. government. It doesn't happen. So because they are responsible for making and receiving payments from the Treasury, they can't be independent. They have to accommodate the Fed, and they will do. And the final reason I already went through has to do with the bond sales. So they got to coordinate the bond sales and possibly bond purchases with the Treasury. The Treasury doesn't buy bonds, but it retires bonds, which has the same effect as buying bonds. It has to coordinate with the Treasury to make sure banks have the right amount of reserves. The only real independence the central banks have is that they can set the overnight interest rate target without political pressure. Okay? They can't be called into Congress and told what interest rate to set. I mean, they can be, but they are not. Congress has given them that independence. So they are free to set the overnight interest rate, and then the chairman of the Fed has to go to Congress sometimes and answer questions about it. Congress, if it wants to, could pass a law and say, from now on, the Fed funds rate will be 1% forever. And this is what the Fed must do. They can do that, but they're not likely to do that. So they've granted them that amount of independence, but that's all there is to it. Okay, and I think two more points. For every surplus, there has to be a deficit. If you think about an economy that just has me and you, if I spend more than my income, by accounting identity, you must have spent less than yours. Okay? If we look at the economy we're actually in, because income in the aggregate has to equal spending in the aggregate, it must be true, again, by identity, that all of the surpluses of households, firms, and governments are equal to all the deficits run by other households, businesses, and governments. Okay? So it's very convenient to divide the economy up into sectors. And we can divide them up any way we want. You know, we could have blonde-haired people and red-haired people, and black-haired people and brown-haired people. The deficits of one of those sectors got to be matched by surpluses of the other ones. Okay, that would be a silly to do. So what we normally do is we say, let's take the private sector, households and firms taken together. Let's take the government sector, all levels of government taken together. And then let's take the rest of the world, okay, all other countries taken together. Okay, that's a convenient breaking up of our economy. Again, this must hold true. If one of those sectors runs a deficit, at least one of the others must have a surplus. The normal situation for the United States is the private sector, taken as a whole, runs a surplus, spends less than its income. And that makes sense. Why? Because households generally want to save for the future. They're saving for kids' college education, they're saving to buy a house, they're saving for retirement. So normally the private sector runs a surplus. The government sector, taken as a whole, almost always runs a deficit. And you can go all the way back to 1789. The U.S. government has run a deficit in all periods except for 7 very short periods in which it ran surpluses. All other periods, it's run deficits. Okay. And the federal government deficits are big enough to more than offset the surpluses that are typically run by lower levels of government. Okay. So that's the normal situation for the United States and for most countries. Our rest of world sector runs a surplus against the United States since the days of Ronald Reagan. Okay. You hear about this as a trade deficit. And we run a trade deficit with the rest of the world. More technically, it's the current account deficit. Our current account deficit is offset by the rest of the world's current account surplus. They run a surplus against us. So take these 3 things together, it balances identically. Okay, I can show you a picture. It's a mirror image. The surpluses run by the private sector, as well as by the rest of the world, are matched by the deficits of the U.S. government, okay, since 1983. Before that, we actually ran current account surpluses, but they were pretty small, we pretty much ignore them. What this means is that it is impossible from accounting for the U.S. private sector to run a surplus and for the U.S. government to run a surplus. Can't happen. Okay? It could only happen if we ran current account surpluses, but we don't, and we're not likely to in the not even the near future, in the foreseeable future. We're not going to run current account surpluses. So if we want our private sector to save, which almost everyone thinks is a good idea, we must have our government running a deficit. Must. As I said, we've only had 7 periods where the U.S. government did not run deficits. The first 6 of those were followed by our only 6 depressions. The 7th was under President Clinton, followed by a severe recession, and then by the global financial collapse. Okay, so not a depression, but bad enough. Deficits are very bad for the U.S. private sector because we achieve them by having the private sector spend more than its income. For 10 years, the United States, before 2007, for 10 years, the U.S. private sector was spending more than its income, going deeply into debt. Okay. And in my view, this is why we had the collapse. The last time the U.S. private sector ran deficits was in 1929, followed by the Great Depression. Private sector deficits are really hard. They're very destabilizing. So For every surplus, there has to be a deficit. We can think of it this way: the federal government deficit provides the private sector surplus in the United States and in most countries. Some countries run current account surpluses. They are able to run a balanced budget or even a government surplus without having their private sector deficit spending. But countries that either run balanced trade or current account deficits need their government to be running a deficit. That provides the saving for the private sector to accumulate net financial assets. Those net financial assets take the form of currency and government bonds. So if you know in Times Square there used to be this debt clock, they moved it a little bit off Times Square, I'm not sure why. You've all seen it, right? The numbers are just flipping like this. It's showing the outstanding U.S. federal government debt. It's supposed to scare the heck out of you, okay? Because it's increasing every minute of every day, right? Except for you could just as well say, here is national savings of our private sector, okay? Because the government deficit is creating the private sector savings. And so it's not debt, it's wealth. Government's creating our net financial wealth in the safest form there is, U.S. Treasuries. What the whole world wants. That's what our government's doing. Last point. If you've got your own currency, you can't run out. You can always afford to spend more. This means you can always afford full employment. You can always afford to hire the unemployed, to create jobs for the unemployed. So one of the policy implications of modern money theory is full employment is completely affordable. You can't run out. The potential danger is it could be inflation. Okay, so we need to deal with that issue. But affordability, running out of money, as President Obama claims, we ran out of money. We would like to do more. During the global financial crisis, we had a stimulus package that lasted only 2 years. President Obama said, we would like to do more, but we just can't afford it. We've run out of money. The piggy bank is empty. This is false. Could have done a lot more. We could have, rather than having 25 million people unemployed, we could have put them to work. We could afford it. Okay, so now let me just quickly give the intellectual foundations of modern money theory. I'm not sure how much this will interest you dead economists, contributions that they had made that were forgotten. So the areas that modern money theory has adopted are work in the past in the areas of credit money, what's called the circuitous approach, endogenous money approach, functional finance, financial instability hypothesis, and the state theory of money. So just very briefly, I'll talk about each one of those and the main contributors that we drew on. So the first is George Frederick Knapp, who wrote the state theory of money. So what he argued is that we need to look at the role of the state in choosing the money of account and issuing currency in that money of account. This was picked up by John Maynard Keynes. Before he wrote the general theory, he wrote a 2-volume work called The Treatise on Money, 1930. And in that book, he explicitly credited Knapp. But he also, long before that, Knapp wrote in German. It wasn't translated until 1924. But long before this, Keynes was the editor of the most important economics journal, even though he's a very young man at the time, the Economic Journal. He wrote a review of 2 articles published by, written by the Queen's ambassador to Washington, a guy named Mitchell Innes, who wrote a book on imprisonment called Martyrdom in Our Times. He's very opposed to using prison to punish. And beekeeping for the Queen. I guess it was her interest. His only other 2 publications. But he wrote 2 articles on money that were published in the Banking Law Journal. They are the 2 best things ever written on money, in my opinion. Clearer than that. Keynes reviewed the first one, 1913, in the Economic Journal in 1914. He said, we might quibble with some of the arguments here, but the overall argument seems to me to be correct. And what Innes did was he started off his article saying, here's the story economists tell about money. And it's the very typical one that is still in every textbook, and if any of you took an economics course, you've heard this before. You had Robinson Crusoe and Friday, they're on an island, they're bartering fish for coconuts, it's very inconvenient, so they decide to use seashells as a medium of exchange. So that's supposed to be the story of the origins of money. And it says that this is all completely false. There is no evidence for this, and it's completely illogical. Okay? So instead, he presents a very different story of money that heavily influenced Keynes. In the late teens, 1919, Keynes had a period that he called his Babylonian madness, investigating what they knew at that time about the development of money in Babylonia. Okay? And it is very similar to Knapp's story that it had to have come from the authorities. So Keynes spent this period studying the earliest money units, and he was sort of surprised to find that earliest money units, all of them that we know about, always were weight units, and they always were grain weight units. So the mina, the shekel, every early money, the pound, the lira, the term always was a weight unit. And so the hypothesis was that these came out of record keeping by the authorities. Okay? And so, anyway, Keynes picks this up and he says, I'm going to quote just very briefly. The state, therefore, comes in, first of all, as the authority of law which enforces the payment of the thing, so this is what I'm saying, the taxes, which corresponds to the name or description in the contracts. But it comes in doubly when, in addition, it claims the right to determine and declare what thing corresponds to the name and to vary its declaration from time to time, when that is to say, it claims the right to re-edit the dictionary. This right is claimed by all modern states and has been so claimed for some 4,000 years at least. So Keynes is pushing the origins of money back 4,000 years at least into the hands of the authorities. Not Robinson Crusoe and Friday. It did not come out of markets. It wasn't a replacement for inconvenient barter. Okay? It had to do with authorities who want to move resources to themselves. Okay? And our understanding of the origins of money is better today than it was in Keynes' time, because we've had more work by historians and by anthropologists. And if anything, Keynes was too conservative in only pushing it back 4,000 years. It looks like it goes back farther than that. It goes back to before writing. In fact, now, the historians of the development of writing think that writing was invented to keep track of money. Okay? all the earliest writing is about debts. And so we're never going to discover the origins of money because we're not going to find, the records. So, but today I invented money, this is how we did it, and so on, because money already existed before writing. So there is speculation involved in it, but it certainly looks like it came out of the authorities. The best explanation that I know of comes from Grierson, who was the most famous expert on coinage. Coinage, by the way, is not old. Coinage only goes back to about 700 BC. So money existed long before coins. He argued that it probably came out of the tribal practice that in the case of Germany is called Wehrgeld. And that is the payment of fines. So in tribal society, if you injure somebody, you owe the family. And there's enforcement of the payment of the fine. So the hypothesis is that gradually over time, the authorities wanted to get some of that payment of the fine. And so now we say, you pay your debt to society. What does it mean? You pay the government. Right? You don't pay the victims anymore, you pay the government. All of this is in Ennis. It's part of this is a critique of imprisonment. Anyway, but what does that mean? It means money didn't come out of the market. It came out of the penal system. It came out of punishment. It came out of fees and fines and then taxes. Taxes are punishment. For what? Original sin. You're born guilty. Okay? So what do we always say? You can escape everything except death and taxes. There's a lot more to say, but it's all bound up in religion. Almost all the terms, everything that has to do with money and debt comes out of religion. The first authority is almost religious authorities that enforced these payments to themselves. So anyway, going back to what is it? It's record keeping. What is that green piece of paper? It's a record. What are wooden tally sticks, which is the way most kings of Europe spent? They issued a tally stick. It's record keeping. It is the debt of the issuer. And this is what Ennis made very clear. All money is debt. It's the debt of the issuer